Can you expand a little bit of the 7 linear hypothesis? It's something I think you didn't have time to expound upon enough, perhaps, in your session this morning at Morningstar.
Yeah. The most important thing is the loss of perceived wealth. We thought for years we were getting rich very rapidly with our houses, even though the underlying reality is a house is a house. The house didn't change, right? But suddenly it was going to have you retire to Florida. And we were also doing nicely in stocks and other real assets, even fine arts and collectibles were on a roll. And as far as we could tell, they totaled about $50 trillion for the US alone. And it dropped below 30. And that's a terrible whack. Even though stocks have recovered, houses and commercial real estate continue to go down, we're probably not far off the 30 level now. And that stranded an enormous amount of debt on the part, mainly in the US this cycle, on the part of consumers. And all that debt has to be restructured. And that's a problem in its own right. But the thing that I obsess about more is just the idea that you felt you were rich. And now you're not. You felt you had a nice fat pension fund and a 401k, and now you don't. And so just as you took holidays based on your capital gains, now you're taking unholidays based on your capital losses. You're going to Rhode Island instead, to the beach.
Do you think prospect theory fits into this at all? With gains giving us 2 times more pain, losses giving us 2 times more pain than gains give us pleasure. Is there perhaps an idea that the propensity, because of these losses, the propensity to save is going to be even sharper than the propensity to spend was when our asset values are rising?
It's quite possible. The thing about the gains, though, is they went on so long that they were reinforcing. Mm-hmm. And making unexpected money 7 years in a row, or 5 years in a row, is not the same as 5 times 1 year. It's cumulative. Mm-hmm. Your confidence rises and rises. Your faith that you're getting rich, in the end, becomes almost uncontrollable. And that very seldom happens on the downside. The downside packs more punch per month.
But it's compressed into a shorter time.
But it's compressed into a shorter time. So whether we're we're probably not more unrealistically bearish and nervous than we were unrealistic bullish, because we were so unrealistically bullish and optimistic. We were just completely out of touch with reality. There are a few people, professional and otherwise, who perhaps are locked into a mindset that's too bearish, but there were millions on the other side who were locked into being too bullish.
So you would say this paints a fairly negative picture for, say, consumer spending and sort of all these things that are really driven by confidence and emotion.
Yes, I would. And I would also add that we're getting older, so there are more retirees per worker than there used to be. There are more people cashing in their houses and going to a cheap, very cheap now, condo in Florida. And there are more people liquidating their portfolios and fewer people building them. So that's, on the margin, a bit of a drag, pushing down, compared to the past 20, 30 years, pushing down a marginal pricing of houses and stocks. There's also a loss of confidence in the effectiveness of our institutions, the effectiveness of our leaders, and maybe even to some extent in capitalism itself. That doesn't help. And by the way, on people, not just people getting older, but fewer. There are fewer people lining up to work each year, not fewer in an absolute sense, but the growth rate has been diminishing steadily. Right. And so it's a downward pressure on GDP growth rates. And the GDP of all the developed countries is suffering mainly for lack of supply of workers.